relative strength index, one of the leading forex and CFD indicators. Now, relative strength index is a momentum indicator developed by a technical analyst called Wells Wilder. Actually, his name would have been perfect for a movie star or maybe a musician. But it was published in 1978 in his book, Concepts for Technical Trading Systems. So think back to 1978. We didn't really there was no online trading. We had virtually no PCs. We had no internet. And most things that we traded that the public traded was the stock market, and still through a broker, or we traded on the commodities exchange. Okay, but you couldn't trade online, so you're calling brokers. So most of the analysis then was done by professionals. But since then, and the growth of online trading, this indicator has been tried in the forex market, the CFD market, by online traders, by retail traders, by newbies, and it's been extremely successful. So without going deep into the workings of the RSI, it is primarily used to attempt to identify overbought and oversold conditions when trading an instrument. RSI is placed on the bottom of your chart, and it's an individual line based on some calculations that come up with a number that we call the relative strength index. Now, it falls into a category called an oscillator, and it's actually called a bounded oscillator. A bounded oscillator is a mathematical calculation that will always come out between a set of numbers. So it's always bound in that set of numbers. An oscillator moves up and down within that set. It oscillates. So RSI will always oscillate between 0 and 100, no matter what the market is doing. When the mathematical calculations are calculated, it will always come out between a 0 and a 100. Not a negative number, not 102, not 127, always between the 0 and 100. And then it is also interpreted between what's called the 30 and the 70. And above 70 and below 30 give us signals. So below 30, the market is said to be oversold, and above 70, the market is said to be overbought. So it's a relatively easy calculation, although you'll never have to calculate it. But I think you should get it out of the way that you understand where the numbers are coming from. And I have a quick couple-second presentation to show you where this comes from. And then we'll go on, and you'll never, ever have to do this again because it's automatically calculated for you and placed on your charts. So to simplify the calculation explanation, RSI has been broken down into basic components. RS, which is the average gain and the average loss. The RSI calculation is based on 14 periods. So if you're looking at a 15-minute chart, it's the last 15 minutes. Looking at a 1 hour chart, it's the last 1 hours. and it would be the gain or the losses in that period. Now, losses are expressed as positive values, not negative values, because we take the first average gain and then average it for the gains over the last 14. But so if there was no gains, that would be 0. And whenever you multiply 0 times another number, it's always 0. So if we had no gains or we had no losses, whenever you do the RS, which is 1 times the other, you're always going to come out to 0, or on the other side, if they were equal, to 100. So then the second and subsequent calculations are based on the prior average of the current gain loss. The average gain is the previous average gain times 13 plus the current average gain for the current chart, the current bar, and we divide that by 14. So you have 13 in the past plus the current one divided by 14. Then the average loss is also the previous average loss times 13 plus the current loss, if there was a current loss. Taking the prior values plus the current value is a smoothing technique similar to that used in calculating EMAs. Now, let's go over, and I'm going to show you how this is put on a chart and show you that you don't have to ever do any calculation. So let's pop up a live chart here. So this is just a simple euro dollar chart. Now, all you have to do is go up to your indicator line, no matter whether you're using it on ETX or you're using it on TradingView or wherever you're using it, drop your indicators and come down and pull up the relative strength index. And the relative strength index normal default would be to use the close price and a 14-period look-back period. Now, you can change it to more and more look-back periods. And what it's going to give you is that calculation, which is called the relative strength indicator. And it's this purple line, which is each look-back period divided by whatever and put in. Now, remember, every indicator, no matter what indicator you're using in the world, only has 4 values, actually 5 values, that it can be calculated on. We have the open, the high, the low, and the close, and possibly volume. Now, we can jimmy these all together, add them into other types of calculations, but they're only those numbers, and those numbers are always the same no matter what chart you're looking at. So whether you're looking at it on ETX in Australia and somebody else is looking at it on the TradingView in Rome, it's still the same number that happened in that same period because it's the true value of the prices. And then RSI does its calculation. MACD does a different calculation using those same numbers. Stochastics does a different calculation using those same numbers. So it's not like they're pulling these magic numbers out of the sky. It's just how they're adding, dividing, and multiplying them together. Now, if we look on the right here, we can see the 0 line and the 100 line. In the center, we see a 50 line. For RSI, the important numbers are 70 and 30. So we're going to go up here, and this is the upper band and the lower band. And we're going to make these black so we can see them easier in class. And we're going to make the lines relatively thick so you can see them better on the chart. And we're going to color in the background with purple. So this is not part of calculations. This is just making it graphically easier to see. So we have our 70 line and our 30 line on the chart. Below this 30, it's technically the market is oversold. And above the 70, the market is considered overbought. Now, overbought and oversold do not mean buy or sell. They also don't mean the trend is going to stop at the moment. So remember, these are momentum indicators, or it's a momentum indicator. So if you think of a momentum indicator as a rocket, and the rocket is shooting up into the air, and you're calculating its momentum, at some point it's going to reach its maximum momentum, and it's going to lose some of its momentum, but it can continue up to a certain period. There's no guarantee it's going to shift over immediately. Okay. So a momentum indicator, or this oscillator breaking above the 70, tells you now the market is too heavy. It's moved up too quickly and it's too heavy, and that rocket is losing its momentum, but it's not telling you exactly when that rocket's going to tip back over. So meaning an overbought market can remain overbought for a while, and oversold market can remain oversold for a while. So if you were in the market, and say you had bought a long position and you were in the market, maybe when RSI went above 70, you might consider getting out of the market. When it came above 70 and then fell back down into below 70, you might consider selling into the market. But it's just a potential alert. That's all it is. Overbought and oversold do not tell you specifically what to do. They tell you something is happening. So let's go back to my PowerPoint. So the default look-back period for RSI is 14. But this can be lowered to increase sensitivity or raised to decrease sensitivity. Now, it's almost like today, all these indicators are, done so easily that people are just going in quickly and changing their parameters. I personally do not ever do this. I use the standard look-back periods. Okay. What I will do is possibly reevaluate my 30 and 70 and say, I'm only paying attention above 80 and below 20. Okay. Because when you change the calculations, it no longer, it stays RSI, but the standard interpretations that you learned about RSI no longer are the same, and you would have to back test it and test it to figure out exactly what is happening. Whereas if you just said, I'm going to change the range above 80 and 20, you're not changing how that oscillator is working. You're just changing your interpretation. So RSI is considered overbought when above 70 and oversold when below 30. These traditional levels can also be adjusted to better fit the security or the analytical requirement. So raising overbought to 80 or lowering overbought to 20 will reduce the amount of overbought and oversold readings. As shorter-term traders, you sometimes use a 2-period RSI to look for overbought and oversold readings above 20 and below 80. So what we're saying here is, let's go back to the chart. We could go into our settings and change this from a 14 period to a 16 period, or a 10 period. And it's no longer than just the standard RSI. Now, you can then use the 70 and the 30, but that calculation to get you above 70 and 30 is no longer the same calculation. My preference is to go back here and leave it at 14 and move this to 80 and 20, because that's not changing any of the calculation. It's just simply changing my interpretation. So as you can see here, I've moved what I consider overbought to a higher number, and you can see that RSI has never gone into the overbought or the oversold position in the recent price movement. Okay. But either way, you can do what you please. I mean, today, these Java charts allow us to do a wee bit too much, because we can also decide we want to change it from the default. Instead of using the close, we could use the open, the high, the low, or the close, or H2, HT, HLC. Too many choices to make a determination on what RSI or any indicator is going to use. So you could say, I only want to use the high. That's going to change your interpretation. What happens is you have lots of these gurus in the marketplace trying to convince you to trade their system. Okay. But then the interpretation is only their interpretation. And again, you don't have any of the years of testing and back testing and verification. Now, once we have this on a chart, and let's go back to changes to the standard 70-30. That wasn't too difficult. We've got it on a chart. We understand what it is, what it's doing. We understand, okay, how can we use this in our trading to make any sense? How can this help us? And this is where we come now. There are many ways we can use this. First of all, we can use it by the overbought and oversold. But we can't blindly just look at a number value and say it's just over top of the 70. We want to look at where it's come from because it can be over top of the 70 right here, but it was higher just a second ago. We also want to look at it in connection to the 50 line because the 50 line lets us know when the trend is changing. So there's a difference between an indicator here, or there's a big difference when it went way over the 70 line, fell back down, and is not able to violate that 70 line again. Then we also have what's called divergence. Divergence is when the indicator is moving the opposite direction of price charts. And each one of these can help us use this to determine how our prices are moving and how we should interpret that price movement. Now, RSI works well in all markets. And it works better in a trending market, either a uptrend or downtrend. In a congested market, it doesn't tell us that much. But we should always be paying attention to the center line, as well as the above 70 and the below 30. So let's talk about how we could incorporate this simple little indicator into our trading. So RSI is used in three ways. The three popular functions are overbought and oversold levels, RSI ranges, and divergence. Now, in lots of times in the media, the newspaper, especially MarketWatch.com and CNN and Bloomberg, you'll hear it say, this stock is oversold. This analyst says it's oversold. Well, this is what most likely they're talking about, that RSI has moved into an above 70 point. Or if they say XYZ is a buy, or because it's moved into an oversold position and we're expecting it to move back up, they're most likely talking to the stock's RSI. Now, unfortunately, it's not as easy buying when the indicator moves below 30 or selling when above 70. Some confirmation of a change in direction is needed. So as we can see on this little example chart over here, we can't just look at the indicator and blindly sell or buy above 70 and below 30. So let me bring you over to another chart that we get set up, and I'll show you a perfect example of RSI. And in this case, we're using RSI on our charts. And when I had done these calculations a couple weeks ago for class, we were here. Now, what we see here is RSI divergence. Okay. And this is using actually a trading wedge also. But what we see is divergence simply means that the indicator is moving the opposite way from the price movement. So we see price movement here forming a beautiful wedge. in a downtrend, while our indicator, let's take this line off, is actually forming an uptrend. Okay, because if we can draw a line between the lowest lows on the indicator, forget the number, the numeric value, we can see it, and it's moving up where price is actually moving down. So the indicator is diverging from price. So in other words, price is making lower lows, because that's the standard definition of a downtrend. Lower lows and lower highs, while the indicator is making higher lows. And you can just observe it. You can see the indicator is moving on upward direction, and the price is moving in a downward direction. And that is known as divergence. Okay. And this is one of the ways we might want to use RSI. You notice in that time frame, even though price was trending in a beautiful downtrend, we were not getting an oversold or overbought anything. Okay, we were strictly in between the 70-30 period, which is really dead man zone. So let me share with you a little presentation on how to use RSI in your actual trading. And then we'll come back and look at how to put RSI on the ETX Trader Pro platform. All right, ladies and gentlemen, when traders first learn about RSI and other oscillators, they tend to gravitate to overbought and oversold values. While these are intuitive points to enter into the market on retracements, this can be counterproductive in strong trending environments. RSI is considered a momentum oscillator, and this means extended trends can keep RSI overbought or oversold for a long period of time. So as we can see here on the example, RSI remained at the 50 level while the trend was peaking out, and then the trend moved into a hardcore down move trend, but RSI didn't fall below the 30 until way into that trend. So we want to keep an eye on the center line. All oscillators have a center line, and more often than not, they become a forgotten backdrop compared to the indicator itself. RSI is no different with a center line found in the middle at the range at the 50. Technical traders use the center line to show shifts in the trend. If RSI is above 50, momentum is considered up, and traders can look for opportunities to buy into the market. Because remember, we always want to buy into the direction of the market. A drop below 50 would indicate the development of a new bearish market trend or a period that we might want to consider selling. Not that we're getting a sell signal, but you only want to be selling in a downtrend, buying in an uptrend. So in the graph, we can see here where the pound dollar, okay, notice when price pushed upward, RSI remained above 50 even at times when the center line acted as an indicator. Support for RSI failed to break below this on the June 24th. And as I pointed out before, we had the price moving sideways at the end of an uptrend and then moving into a downtrend, whereas the indicator stayed above the 50 and didn't fall below the 50. But once it started moving down below the 50, we could then look for sell opportunities. So keep an eye on that center line. Now, let me show you how you would do this. Now, I've explained this in some of our classes on charting. The difference between free charts like on TradingView or on investing.com or wherever else you can get charts is that they use delayed feeds because price feeds are extremely expensive. And therefore, free charts or low-paying charts are give you delay feed. Nobody's trying to pull the wool over your eyes. In fact, if you're using a TradingView free chart, it's going to tell you exactly what the delay is. It's only a couple seconds, but that makes a big difference in the cost of that data feed. And believe me, they are very expensive, and you're having to buy data feeds for every asset out there. Now, on the platform, on the ETX platform, we already have all the data feeds because we have to have all those feeds and all those up to the second prices in order for you to trade. So that same data is being fed into our charts. So you're getting the fastest data feeds possible into your price charts. So you're going to find that the price charts on ETX platform are a lot faster and more responsive. So keep that in mind. So let's see how we would put RSI and indicators on the ETX charts. So with RSI, the bottom line is RSI is popular because it has multiple uses. It also is popular because it's withstood the test of time. It's been used since 1978 and keeps gaining in popularity. And that only happens because it's a reliable indicator. It is used to find exit signals, entry and exit signals based on several different premises, overbought and oversold readings, and trending ranges, and can help spot and confirm reversals via divergence. Like any technical analysis tool, though, the RSI is prone to providing false signals. Price analysis is still needed to determine if a trend is present, and then important RSI levels identified for that particular security. So thank you very much for joining us this evening. I hope you learned a little bit about RSI, and we'll talk to you again real soon. Have a great trading week and an enjoyable weekend. Bye now.